Hi guys! Are you wondering why you should watch this video? Because today you will learn a secret strategy that nobody trades on except me. I'll show you all the nuances and details and it's gonna be hot. So tune in and let's get started. So we set three indicators: CCI with a period of 20, RSI with a period of 7, Williams R with a period of 14, and on the US dollar / China yuan OTC currency pair, I make a deal to increase for 2 minutes for $1,000. I'll be boosting the deposit. Now listen carefully. I saw that all three indicators are under the bottom line each and they begin to go up. This means that the price is in the oversold zone, which means that the price is strongly overbought, so it must go up. Also, in this combination, a level from which the price should bounce off should serve as a confirmation, but it is not there, so I rely on three indicators. Now I'll tell you about the main rules of a professional trader that you must apply. The market is a dynamically changing system that is constantly in motion. Every quote rises and falls as it develops, and aggressive trading often leads to negative consequences for the trader. Just one losing trade can lead to a crash of your deposit. The first rule is never to invest more than 30% of your capital in one trade, no matter how profitable it seems to you. Do not bring losses to a total crash. With further competent actions, you will be able to beat off the lost amount in a short period of time. A reasonable bet using standard diversification, which means distribution of capital across trades, is no more than 5% of the capital. So our deal is in the black and we earned $910. On the next currency pair, Australian dollar / US dollar, OTC, I'm placing a trade betting on a decrease for 2 minutes with $2,000. And listen up, the price has approached a resistance level from which it has bounced back multiple times, indicating that this level indeed provides resistance, and the resistance is from sellers. Remember, resistance level implies resistance from sellers, and a support level implies resistance from buyers, meaning sellers are on top, preventing the price from going up, and buyers are below, preventing the price from going down. Also, all three indicators are in the overbought zone, that is above the top line. So if the indicator readings are on top, it means sellers are going to sell the asset now. Therefore, the price should go down. Alright, let's get back to the talk. The second rule, take into account the psychological factor affecting every trader. For example, the desire to get back ultimately always leads to a drain of capital. If you have made a whole series of unsuccessful trades, leave the market for a while. Analyze your behavior, complete the transactions, and only after you have normalized your feelings and emotions, start working again. Third rule, it is not recommended for beginners to place more than 3 bets simultaneously. Your mind simply cannot handle all the necessary information, even though it may seem otherwise to you. If you ignore this rule, over time you will start noticing losses and shortcomings in your trading. Rule number 4, learn, learn, and learn. Again, this is the most important rule for every trader. And our trade goes successfully into profit with a gain of $1,580, and let's move on. So on the currency pair of Euro / United States dollar, OTC, I'm placing a trade betting on an increase for the 2 minutes with $3,000. Now observe, the price is in a sideways trend, meaning moving within a box from resistance level to support level. Now, as the price has approached the support level, this indicates that buyers are located at this support level who will be purchasing the asset. This is a reliable level from which the price has rebounded multiple times. Also, all three of my indicators, which are in the oversold zone, confirm my analysis, and this means the asset is oversold and should be bought now. Hence why all three indicators cross the oversold zone from below, implying the price should go up. Okay, let's keep talking. Now, let me talk to you about the importance of news reading in trading. I'm going to, share a secret, a holy grail that will make your trading successful. You can spend endless hours fine-tuning your trading strategy, selecting suitable indicators, formulating trading rules, etc. But everything goes away the moment significant economic news is released. During these times, the market often behaves unpredictably and the price might shoot in directions that, based on all analytical rules, it shouldn't. This often leads to losses, so professionals advise beginners to be very wise about that. They emphasize that before entering the market, one should check if there are any major news scheduled to release soon. You can find the economic calendar on the investing.com website. This useful tool is a table listening to um, all the news in the order they come out. The importance level of the upcoming news is very high and it substantially affects the market situation. And it's also worth being cautious when news with two symbols is released, as they too can influence the market. If the news positively impacts a certain asset, you can expect its market value to rise and buy an option for an increase. If the data turns out negative, it's better to opt for a decrease. So, here's a little secret on how to trade based on the news. For instance, you make a move and boom, you're up $2,580. On the US dollar / Canadian dollar OTC, I made a 2-minute short bet for $3,000. The price trend was heading south. It was nearing a resistance level, which means sellers might start offloading. It's a solid level since the price has bounced off it multiple times. Also, the CCI and Williams R indicators suggest it's overbought and might turn around, so it looks like the price might take a dip. Pop open an economic calendar and spot the big news for the asset you're watching. Wait for that event to drop and see where the price goes. Chill for a minute or two. If the chart's climbing, bet on it going down. If it's dropping, time to buy. If things don't pan out and you lose money, go the same way again but up your bet by 2.5x. It's the martingale move. Then hang tight for the next big news, the ones with 2 or 3 stars next to them. This method can score you some extra cash, but if you want to make big bucks trading, you've got to master technical analysis too. Speaking of technical analysis for binary options, it's all about those charts and indicators at the end of the day. You've got to have your own game plan to decide when to make a move. The essence: spot patterns to find the best time to jump in. You can use support or resistance levels, various patterns, indicators, and other tricks. Like imagine a live chart that can hint at where the price is headed. Alright, back to our chat. Keep in mind that using technical analysis in binary options trading will differ substantially from its use in any other financial market. When trading Forex, for example, technical analysis aims to identify entry and exit points for a trade. But in binary options trading, all you need to do is predict where the price will go and hit a button. That's it. This distinction allows beginners to quickly get the hang of trading binary options and start making a profit. Also, technical analysis for binary options is often called charting since price predictions are made based on past prices. This involves using charts and the asset's price history. So our trade is in the green and we've earned $2,760. I'm entering a trade on the Euro / TRY OTC currency pair for 2 minutes downwards with $4,000. The price was going up, approaching a resistance level from which I expect the price to reverse. All 3 indicators are in the overbought zone, meaning the price is overbought and it should now go down. Let's get back to the conversation in the meantime. There are 3 types of trends: bullish, which means rising, bearish, falling, and sideways, so flat. With a bullish trend, the price is going up and you should buy a up option. In a bearish trend, the price is falling and you should invest in a down option. When the chart shows a sideways trend, you should either trade from level to level, that's scalping, or skip it altogether. But the price is always in motion and one trend replaces another. That's why waves form on the chart. Next key concept is volatility, which shows how much the price is tossed from side to side, from level to level. And there are many strategies on how to trade using technical analysis, using trading with indicators, but let's talk about that some other time. Firstly, price action methodology. It's the Western version of candlestick analysis. This system is entirely built on price movements and doesn't require indicators to work. Many traders consider it the holy grail, just like the candlestick technique. Most patterns in this method work strictly on supports and resistances. Secondly, predicting market fluctuations using chart patterns. Chart patterns are specific shapes that emerge on the price line. So, fundamental analysis. The analysis of the economic reasons for market fluctuations. Why is the euro rising? When could this rise end? The reason for the rise or fall could be a change in the world's economic situation, the release of important news, macroeconomic reports related to a particular asset. And our trade goes into profit and we earned $3,680. And now on the euro slash ruble OTC currency pair, I enter a trade for an increase for 2 minutes with $5,000. The price was confidently moving down with solid candles, but as it approached the support level, I noticed that the candles got smaller, meaning that the sellers were losing their power to push the price down. All three indicators, which have been in the oversold zone for quite some time and have formed a pit, confirm this. This means that this movement should come to an end and the price should turn around and go up. All economic reports and indicators are published regularly, monthly, quarterly, yearly reports, and the time of publication is known in advance, which makes it easier to track market changes. Based on whether the news is positive or negative, it is possible to understand in which direction the price will go. And fundamental analysis allows identifying the root cause of price behavior, meaning connecting a specific event with a specific movement, having preliminarily assessed the degree and sphere of its influence. The result of the analysis should answer the question of what is happening in a specific company, uh, honestly, any area of influence, and how it will affect the future. Combining fundamental and technical analysis in binary trading can give traders a clear understanding of direction. When these two different market analysis methods are used in tandem, it can potentially increase the advantages and reduce the potential risks associated with a certain move. Now, let's talk about the advantages. Comprehensive market view. By combining both analysis, traders can gain a holistic view of the market. Fundamental analysis provides an outlook on the economic situation, that is, it gives an understanding of why the price is impulsing and why it is on the rise. Technical analysis, on the other hand, helps to observe and discern any patterns that are occurring at the present moment. Alright, so our trade goes into profit, earning $16,110 for the session. Alright guys, thanks for watching this video. You watched this video and you are great because you have taken a step towards wealth. I wish you all good luck and have a great day. I'll see you later. Bye bye.